Good evening and warm welcome. We are close to the end of the year and it has been a volatile one for the market. We witnessed sharp swings driven by multiple events, especially tariff related issues, which still remain unresolved. The market fell nearly 17% at one point of time, but the strong recovery within the same year was remarkable and has helped to restore investor confidence. Tomorrow's credit policy will be an important event, and opinions are split. The rupee has been weakening for the past 2 weeks, making RBI's decision even more challenging. After the policy, the market will shift its focus to the Fed meeting on 10th of December for rate cut signals, followed by discussion around the union budget and Q3 results in the year 2026. Overall, the next 3 months look eventful and exciting. To understand where to focus, Sumit will take us through the details. Over to you, Sumit.
Thank you very much. As Shrikant sir has rightly mentioned, the market has been very volatile during this year. We have seen ups and downs, but Nifty remained in a very range-bound manner also. So let's break down the state of the market and the global economy in a way that doesn't make your brain hurt. First up, India's market outlook. In November particularly, if I talk about the performance, was a good month. The Nifty 50 and Sensex hit record highs. Why? Because investors are getting excited about expectations of US and domestic interest rate cuts. Add to that improving corporate earnings, GST cuts, and easing crude oil prices. And you have got a positive market outlook too. Though small cap stocks are not quite keeping up well with the large caps, they are like the kids who insist on running in the opposite direction during the race. If you are looking for market winners, focus on businesses with solid, sustainable models and management. You know that good students can be found out in the market if you follow these principles. The broader universe of Nifty 500 companies that will give you a full perspective of the market isn't exactly setting the world on fire. Revenues only up 6% year on year, but there is good news that operating profit growth was up by 17% and profit after tax is also looking solid with a 15% growth. So despite the struggle, we are seeing some resilience. Big companies are still dominating the profit game, making up almost 73% of the total profit pool. So when I'm saying big companies, I'm talking about Nifty 100 companies are contributing 73% of the total profit earned by Nifty 500 companies. And what about smaller companies? Obviously not so much. The government rolled out new labor codes that could improve productivity, reduce compliance headaches, and even open up more opportunities for women with rules around night shifts. But there is a catch. Employers will need to adapt to these changes and there might be a one-time cost bump. Now, importantly, everybody is talking about the GDP numbers which have come recently, and that's obviously very surprising. That's why everybody is talking about. India's GDP growth is cruising at a solid 8.2% for Q2 FY26. And we are revising our FY26 growth estimate to 7.8%. Obviously, on the back of strong numbers which the country has reported. Private consumption is growing very good. Investments are steady and the festival season could give GDP a nice little bump. We are also seeing inflation calm down, which gives room for potential rate cuts. Now, this is a big question everybody has got. What will RBI do? Will they cut or they will not cut? So my guess or Kotak's guess is that or we are expecting a possible 25 basis point cut in December but we are keeping our fingers crossed. Okay, so India's goods, that was on the positive side. Now look at the darker side of the India. So India's goods trade deficit hit a record high of 4.17 billion US dollars in October. Exports dipped a bit while imports, especially gold and electronics, surged. This could put some pressure on the external balance. So we might see the rupee staying in a range between 87.50 to 89 in the coming months. A lot will depend on RBI's intervention. This we talked about domestic markets, why Indian markets are doing well, what are the reasons. Now let's take a flight to the global market. Now globally, stimulus is the name of the game. The US is handing out a $2,000 checks, though date is not confirmed. But look at the amount which everybody is talking. So everybody, they are talking about giving $2,000 check to everyone out there, meeting certain criteria. Similarly, Japan got a massive 110 billion US dollar stimulus aimed at containing the deflation. China is offering a hefty 1.4 trillion US dollars package to stabilize local governments and counter trade conflicts. So, as I said in the beginning, globally, stimulus is the name of the game. In fact, the US Treasury is issuing nearly 1.9 trillion US dollars in net debt every year. That's a lot, isn't it? Meanwhile, Canada is reintroducing quantitative easing. So at one point, we are saying that central banks are infusing lots and lots of fund in the global markets. So that again, the liquidity is infused. A lot of money will come in, the money supply will come. The global money supply has a hit of 137 trillion US dollars, and over 320 basis point rate cut has happened worldwide in the last 2 years, signaling a global easing trend. All of this means liquidity going up and inflation keeping central bank on their toes. So what does that all means? For equity markets, liquidity is definitely a big catalyst, a big positive catalyst, and I think that will help global markets and Indian markets. So what's the bottom line? The world is moving into a major stimulus cycle, from $2,000 checks in the US to a massive fiscal package in China and Japan. Next, please. So if you look at the global indices performance, Nifty Bank has given a 3.4% return, which is quite impressive. Sensex has given a return of 2.1% and Nifty 50 1.9%. So the numbers look quite impressive in the November month. But if you look at other global markets, they have given a negative return. So that is quite positive to that extent. Next, please. Coming to the sector-specific performance, BSE IT index has given a 3.7% return, which is quite positive. And obviously, they were the laggards earlier, but they could able to catch up in this month, November month. Going forward, if you look at the valuation and the catalyst which is available for the IT sector, valuations are reasonable out here, and US rate cuts will be big positive for Indian IT services company. The next sector which we like is the private banks, where the valuations are very comforting. And if you look at the past average of last maybe 5-10 years, then they are trading at a lower than that, those valuations. So again, that is quite impressive. When I'm talking about BankX, I'm talking about price to book value as a multiple to look at it. So BSE IT, BSE Auto, BSE BankX, BSE Telecom, BSE Consumer Durables have given a broad single-digit positive numbers, and finally BSE Healthcare. However, other sectors have yet to perform. Next, please. this I have discussed. What is more important to remember that we are revising our FY26 real GDP growth estimate to 7.8%. Earlier it was 6.5% because of the strong numbers which has been reported, and project FY27 growth at 6.5%. Next, please. Rate cut which we discussed, we are expecting around 25 basis point cut, but we are keeping our fingers crossed at the same time. The good part is that inflation is on your side. Lower inflation, which is quite positive for RBI to think of cutting the rates. But if you look at the next year, maybe FY27, we are expecting inflation to go up. So we believe this is a very short window which is available for RBI to cut rates, and they should grab this opportunity. Next, please. Coming to outlook and valuation, India is one of the world's fastest growing major economies. Automobile sector saw earnings upgrade following GST rate cuts. Earnings downgrade in the IT sector due to demand uncertainty. We believe that once this trade tariff war will get over, lot clarity will come, and there's a lot of pent-up demand. Let me tell you one thing. But because of the uncertainty, clients are not spending that much. So we are waiting for that uncertainty to go, and then that pent-up demand will come, and we will see huge money going towards IT services investments. Coming to the net profit of Nifty 50, back please. Net profit of Nifty 50 index to grow around 8.2% in FY26. That will result in an EPS of 1,077 rupees. And in FY27, we are expecting 17.6% EPS growth, which will result into 1,269 rupees. Going 1 year ahead in FY28, we are expecting 14.8% year-on-year growth with an EPS of 1,456 rupees. Nifty 50 index is trading at 20.6 times and 18 times in FY27 and 28. Next, please. So this is a chart that will tell you the price to earning multiple at which Nifty is currently trading, and in the past how the trend has been. Obviously, we are above the average. We are in fact one standard deviation above the mean. But what is more important to remember that we are also the fastest growing economy. So that's why the confidence, the political stability, and other multiple factors which are in favor of India is supporting such high valuations. And we are optimistic that earnings growth will come next year and beyond that. Next, please. So in brief, if I have to summarize and what will be the key takeaway for you to understand in short and sweet, India's growth potential triggers are many, multiple drivers at play, which has supported Nifty to record highs. First and foremost, strong government focus on growth, which is very important to understand. If the government is very keen to grow the GDP and supporting the policies or giving supporting policies, then definitely market really likes that. One of the biggest concerns for us is crude oil prices, because we are more than 85% dependent on imported crude of what we consume. So lower crude oil prices is again a positive for us, and hopes of progress towards peace between Russia and Ukraine. Thirdly, if you look at strong domestic demand, which we have seen post the GST cuts, US and India rate cut will be again triggers for the market. Record-breaking domestic flows, but unfortunately that is not been followed by FII buying. We have seen a lot of selling by FII. And one of the factors which is also keeping the market under check is the number of IPOs which are coming. So the number of paper supply which is going up, which is also taking away part of the liquidity. Now coming to top investment ideas. Now this is interesting, and we have been time and again sharing stock ideas with you, and they have given quite impressive returns. So those who are following should continue to follow this. And people who are new to it, just try to understand what is the message which we are giving. And these stocks have been filtered based on lot of analysis which we have done. So Infosys, we are recommending buy with a fair value of 1,800 rupees. Infosys is chugging along nicely despite a few headwinds. Well, the company is well positioned to lead on revenue growth as demand more favorable as it was there in the recent past. It is well positioned to navigate technology inflection driven by generative AI. So this will give, so what is happening globally up till now, lot of investments have gone towards developing the infrastructure for the generative AI. Now that part is has been taken care to a large extent. Now it is expected that now the money will flow towards more IT services, and that will take or that will help Indian IT services company going forward. The company has raised its guidance to 2 to 3%. Expect Infosys to achieve closer to the upper end. Total contract value of 310 crore US dollars was in line with our expectation, which the company has reported in Q2. Now, what is important to understand is why this TCV is important. That gives you an idea how much orders they have. Out of these orders, they are going to execute and convert that order into revenue. So if your order book is healthy, then definitely that gives you long revenue visibility. Now, the second part is the execution capability, which is not being questioned so far Infosys is concerned. So we maintain buy with a fair value of 1,800 rupees. Next, please. Over to Amit.
Thank you, Sumit, for the detailed presentation. Next investment idea for the month of December is Godrej Consumer. We have an ad rating with a target price of 185. अगर आप पूरा FMCG स्पेस देखें तो लास्ट 3 साल से काफी अंडर परफॉर्म किया है बट second quarter we have seen sentiments changing for the segment and we have seen improvement in numbers and margins for the entire sector. And with GST rate cut and with good monsoons, we are expecting the next 2 quarters to be very good for most of the consumer companies. जो GST रेट कट हुआ था अगस्त में उसके वजह से थोड़ा सा शॉर्ट टर्म डिस्ट्रप्शन फेस किया है मोस्ट कंज्यूमर कंपनीज इंक्लूडिंग गोदरेज कंज्यूमर मैनेजमेंट ने ये क्वांटिफाई किया कि 3 से 4% तक का हिट हुआ है टॉप लाइन इस क्वार्टर में बिकॉज ऑफ destocking and channel price adjustment. We believe that the transition following the recent GST rate reduction will only lead to short-term disruptions in channels while adjusting to new pricing and old inventory will be cleared. Particularly which will impact segments like soaps and hair color. इस सब के बावजूद हमें ऐसा लगता है कि जीएस गोदरेज कंज्यूमर विल कंटिन्यू टू गेन मार्केट शेयर इन सोप्स एंड अदर की कैटेगरीज डिमांड आगे जाके नॉर्मलाइज हो जाएगा एज ट्रेड चैनल स्टेबलाइजेस पाम ऑयल जो काफ़ी वॉलेटाइल है बट थोड़ा सा रेंज बाउंड हो गया है कंपनी ने ये बताया कि एवरीथिंग इज लार्जली प्राइस्ड एट करंट लेवल्स एंड डज नॉट एंटिसिपेट एनी raw material margin pressure from especially from palm oil. Adequate palm oil availability in India and favorable pricing will support margins going forward. मैनेजमेंट ओवरऑल एक्सपेक्ट कर रहा है कि जो इंडिया का स्टैंड एलोन बिजनेस है वो हाई सिंगल डिजिट वॉल्यूम ग्रोथ दिखाएगा इन FY26 while consolidated भी हाई सिंगल डिजिट में आएगा with H2 expected to be far better than H1 FY26. कंपनी ने ये भी बोला है कि दे आर ट्राइंग टू इम्प्रूव दैर टोटल एड्रेसेबल मार्केट बाय फॉलोइंग इनटू न्यूअर एंड फास्टर ग्रोइंग सेगमेंट्स and continue to strengthen its core portfolio, aided by channel restocking and some improvement in underlying demand. Company expects its margins to hover between 24 to 26%, starting Q3 FY26. Besides, the company has made consistent efforts to address gaps in profitability and also improve its international business. तो ओवरऑल जो ग्रोथ सेंट्रिक फोकस है कंपनी का और जो सेंटिमेंट्स ऑन द ग्राउंड इम्प्रूव हुआ है, वी रिमेन कंस्ट्रक्टिव ऑन some of the FMCG companies, including Godrej Consumer, Varun Beverages, Tata Consumer, and Pidilite. That's it from my side. Over to Pankaj.
Okay.
Over to Arun, sorry.
Yeah, thanks, Amit. Yeah. So we'll talk on Mahindra and Mahindra. That again is one of our picks which we have been sharing with you all for, I don't know, maybe more than a couple of years or so, and the stock has really done well. And we still like the stock because the story continues to play for them, and that story is basically a very, very strong volume growth with outperformance vis-a-vis the industry. Now, as we all know, Mahindra is broadly in the auto side in three segments. One is the SUV segment, the other is tractors, and third is the light commercial vehicle segment. So when you look at the SUV or the auto segment, just to give you one example, last year the company had 22.7% market share. This year, in first half, they've increased to 26.4%, making them one of the fastest growing SUV brands in India. And the company will continue to focus on this, growth. They are planning to launch a lot of new products over the coming years in the SUV side, and that should help them compete strongly in the SUV segment. The second is the tractor segment, where Mahindra is the world's largest tractor manufacturer, and we'll also say they're India's most profitable tractor OEM. They have around 43% market share in that, and the penetration level in terms of the power requirement in India remains still low, and we believe the tractor volume growth coupled with a lot of farm mechanization equipments are also underpenetrated at this point in time. So these growth will help the company to continue to outperform or in fact grow strongly over the coming years. The monsoons have been good, so tractor demand so far have been good. The third business which they are into is the light commercial vehicle. There they are present into less than 3.5 ton category. Largely, and they hold again, last year it was around 52% market share. In first half of this year, it's already moved to 54% market share, and they again are the undisputed market leader in that specific category which we talked about. The company is planning to launch few products out there. We are seeing recovery happening in that segment, and that should support growth. So overall, for Mahindra, what has worked for them in the past is led by new products. They have been able to grow strongly in the industry, and we believe that they will continue to follow that specific path. Now, the company also recently held their analyst meet, and they highlighted a few points. I'll just highlight four points here. One, they talked about capitalizing on their market leadership in the auto and the farm segment. The second, they talked about unlocking the potential in finance and technology subsidiaries. So Mahindra also have got a lot of subsidiaries, so they are looking to unlock the potential specifically in the finance and technology subsidiaries. Now, the company has got a lot of smaller investments and smaller companies, which they call growth gems, and they like to see multiple times growth in these companies over the years to come. And now they'll have to definitely invest in this company, so they have said that they'll be very disciplined in the capital allocation as well. Overall, we remain positive on the stock. The auto numbers which keep coming, everyone, they have been reporting very strong numbers. So that's one of the pick in the auto side, where we have a buy rating, fair value of 4,200. Next one. Eureka Forbes is company which we are positive on. The company largely has got businesses which is water purification. Most of us would definitely be aware of that part. They also have smaller businesses like vacuum cleaning and air purification. They have got direct, retail, e-com, institutional channels, and they are looking for improving the network going forward as well. Now, even Eureka Forbes did a meeting recently, and they have talked about growing their revenues by around 17 to 18% CAGR from between FY25 to FY30. So over a 5-year period, they want to grow their revenues in a very high double digit. Apart from that, even on the EBITDA side, they are looking to see their EBITDA growth, or they expect their EBITDA to grow more than 20% during that period, and the margins also to expand meaningfully from the current levels. The company, when we look at FY25 numbers, we look at first half numbers for Eureka Forbes, they have shown a double-digit revenue growth, and even we have seen healthy margin expansion for that. So the company continues to have been looking at certain segments. They have highlighted certain categories where they think will be the growth drivers going for them. So we are positive on the stock. We expect a very healthy revenue, EBITDA, and profit growth for the company over the next few years. And we have a buy rating again here and a fair value of 800 rupees. That's it from my side. Over to Veer.
Yeah, thank you, sir. Hello to all. A very good afternoon. So, I, ICICI Bank is one of our top picks from the banking space. Here we have a buy rating with a fair value of 1,800. So अगर हम पहले lending space की बात करें, so we are of the opinion that H2 for the lending players are going to be better than the H1. Now, why do we say this is because number one is that H1 में हमने देखा कि the loan growth of all the banks have been pretty subdued. But H2 में going forward, we are seeing signs of good revival. So recently RBI reported their Q2 industry data for all the banks. और वहाँ भी हमें देखने मिला कि we are seeing a loan growth revival taking place and decent revival across retail, corporate and MSME. नंबर टू अगर हम मार्जिन्स की बात करें सो हम ऐसा मानते हैं कि Q2 में द मार्जिन्स हैव बॉटम्ड आउट फॉर द बैंकिंग स्पेस एंड गोइंग फॉरवर्ड द डाउनसाइड रिस्क टू मार्जिन नहीं है सो एक स्टेबल मार्जिन एक्सपेक्ट कर सकते हैं फॉर द बैंकिंग प्लेयर्स एंड मे बी Q1 ऑफ नेक्स्ट फाइनेंशियल ईयर ऑनवर्ड से वी कैन ऑल्सो सी टेलविंड्स फॉर द मार्जिन टेकिंग प्लेस नंबर थ्री अगर हम बात करें GNPA नेट NPA रेशियो की क्वालिटी ऑफ द बुक की सो असेट क्वालिटी ऑफ द बैंक्स H1 में भी काफी अच्छी डिसेंट रही है and their decent trend we are expecting to continue in H2 as well. Some segments such as unsecured side, personal loan side, microfinance side, here we are of the opinion that the worst of the stress is behind us now. And going forward, this is not going to really hurt the balance sheet of the banks. Therefore, if you see all the three major matrices, be it loan growth, margin or asset quality, everything is looking pretty stable for the banking space. And at a time like this, one of the top player is this bank, and this bank would obviously then would be benefited by these good tailwinds. ICICI बैंक ने Q2 में काफी stable performance दिया था. As per the industry trends, they reported decent loan growth and business growth trends. Margin जो हम expect कर रहे थे एक stabilization H2 में आएगा, for ICICI बैंक ये Q2 में ही आ गया, which is obviously a very positive sign. Their asset quality remains very good and best in class if we compare to its close peers. So वहाँ भी ऐसा कोई problem देखने नहीं मिलती. ICICI बैंक अगर हम उसका stock performance देखें तो it has seen a relatively more fall versus its frontline peers. So इसका मतलब ये है कि we are getting ICICI Bank at a better risk reward now than it was before, and this therefore makes us more confident to recommend this stock at these levels, and therefore it's a stock which we like. I repeat, on ICICI Bank we have a buy rating with a fair value of 1,800. That's from our side. I hand over to Rini now.
Thank you, Veer, and thank you, team, for the presentation. We have now opened the floor for Q&A. So ask your questions now. I and my team are happy to take your queries. Starting with the first question we have. So Sandeep is asking, what's your target on realty sector? Is it bearish or bullish? For this, we have our realty sector analyst, Pankaj Kumar. Pankaj sir, can you share your views?
Yeah. So real estate sector, I believe the question is on the outlook on the of the sector. So if you see the recent time, we have seen the companies, select companies have reported very good numbers, and under the stocks which are under our coverage have also reported a very strong growth in the pre-sales number of more than 40%. But when we look at the industry, so industry pre-sales has grown at around 11%. And that's too on the value in the value terms, and it's largely driven by the price increase that we have seen over last 1 year. When we look at the volumes, it has been largely flattish. So in fact, some of the reasons behind the same is the base effect that we have seen. The last 3 years has been very strong for the industry. The industry has grown at a double-digit growth rate, and that has come in play. And even inventory, when we see right now, is 1.6 years, though it has increased, but it's still at a
comfortable level. So point I would like to make is we may see some near-term moderation looking at the base effect and also some of the launches that depends upon approvals also. For select large companies, the stocks which are under coverage, they will continue to do well. They have given the guidance, growth guidance, which they are able to meet comfortably. And stocks have also corrected. We have seen now the valuations are attractive. Some of the stocks we see even more than 30-40% upsides as well, like DLF or say Lodha, Brigade and all. Prestige is also looking attractive at these levels. So these stocks are at 7 to 10, 11 times on EV/EBITDA. So that's an attractive level. One can look at these stocks from long-term perspective because long-term outlook remains positive. The sector is we continue to see the consolidation theme will continue और डिमांड भी लॉन्ग टर्म में कंस्ट्रक्टिव है वी हैव हमारा व्यू भी कंस्ट्रक्टिव है सेक्टर पे so this is our view on the sector.
Thank you. Next question is from oil and gas space. So Rajkumar Singhal is asking, what is your view on GAIL, ONGC and Oil India? For this, we have our oil and gas sector analyst, Sumit sir. Sumit sir, over to you.
Yeah. Generally, people buy PSU stocks for getting good dividends. So I believe the investor is asking from that perspective. Yes, we agree that these companies are good at paying dividend, but so far capital appreciation is concerned, we need to see what's the earning growth trajectory of these companies. So particularly for GAIL, we believe that for next 2 or 3 years, the earnings growth will be almost zero. The PAT growth will be almost zero. Why? Because of the higher capex they are doing, the depreciation interest cost will take away the growth which is coming in the operating profit. First. Second, so GAIL, we are not very positive. One can avoid, our fair value is 145 rupees. Oil India, again, we are not very gung-ho about it. You can avoid it. In the upstream segment, if you want to focus, then ONGC stock, which we like a lot. We believe the earnings is expected to grow from, or particularly the EPS is expected to grow from 40 rupees in FY26 to 48 rupees in FY28. The stock is available at a price to earning multiple of 5 times. So we believe the fair value of this stock is around 295. So there is a decent upside. So from a longer term perspective, one can focus on ONGC. Obviously, there are risk concerns in terms of commodity. If the crude corrects for whatever reasons like geopolitical risk settling down and other things, then that will be negative. Otherwise, weaker currency is positive for upstream companies. So that is good so far. ONGC and Oil India is concerned. Over to you, Rima.
Thank you. Next question is from Pawan Kothari. He's asking, sir, what's your view on auto ancillaries at present? For this, we have our auto sector analyst, Arun Agarwal. Sir, can you share your view?
Yeah, so see, the auto volumes are doing well. In fact, last month, when we look at the overall, all the segments in the auto segment do well, and hence the interest, I believe, would be there. Looking at which of the auto ancillary sector companies, or if the entire sector would look good. But here, see, one has to understand that auto ancillary per se is a very, very wide sector, so you can't have a single lens looking through the entire sector. What we need to understand here is the business mix as well. So just to give you an example, one has to look if the businesses are largely coming from OEM volumes or replacement. So there are companies like say tire companies, battery companies, where a very large portion come from replacement mix. So if the OEM volumes picked up significantly, the benefits would be restricted to these kind of companies. So one has to look with companies where the OEM mix would be high if the auto volumes are increasing. The second would be the mix between the auto and non-auto. For example, bearings. Bearing sector has got a good significant mix of non-auto as well. So while autos could be doing well, bearings may not do well. But I mean, just giving you an example there. So if both the segments do well for them, so that would be good for bearings. The third is the domestic and exports. We have to focus, I think, at this point in time, more on companies which are more domestic oriented rather than companies which have got higher exports. Now, the reason for that is because there are huge headwinds that we are seeing in exports, and also from from the US tariff deal not happening right now. If the US tariff deal happen, yes, we'll see a lot of these companies who have got higher export exposure will may do well. But for the time being, I think the focus should be on domestic companies which are got higher OEM share, and the companies which has got a higher, automotive volume side. Now within that, one can, talk about should it be a two-wheeler company, a passenger vehicle, a commercial vehicle, or tractor-based auto ancillary company. So again, I think all the segments are doing well, but we believe the volume growth will remain healthy for all the segments. So that's not a major concern. And the last would be that, in the OEM space, companies can grow just because of volume, and there are companies which will grow because of value added mix as well. So I think both the companies, these set of companies could do well. Now, in our coverage universe, what we cover, the companies that we like at these levels, or some companies we can use or can be bottom dips, include the endurance technologies. In bearing space, we like Timken India, and in the smaller ancillary space, we like PM Industries.
Sir, you have any views on Motherson? We have one query on Motherson.
Motherson, I think right now we are not that very optimistic given the overall. I think this is more to do with Samvardhana Motherson. So here, I think the overall concern right now is that the overall global situation is not that very optimistic as I talked about right now. So we'll wait and watch for Motherson at this point in time.
Thank you. Next question is on Varun Beverages. One of our participants wants to know view on Varun Beverages. For this, we have our FMCG sector analyst, Amit Agarwal. Can you share your views, sir?
Yeah. Varun Beverages, currently we have an ad rating with a target price of 550. In fact, entire street is very optimistic on the stock. Last 2 quarters have been weak for the company, primarily because of excessive rains and also due to Operation Sindoor. But going forward, we expect things to structurally improve for the company. Company is also venturing into areas like alcoholic beverages. To start with, the company has tied up with Carlsberg in Kenya, and they want to experiment the same in India as well. The IPO of Coca-Cola bottler also will give some support to the stock. So overall, we expect things to structurally improve for the company. We are expecting over 20% earnings CAGR for the company for the next 2 financial years with ROE of 20%, and we are positive on the stock. Stock is trading almost at 52-week low, and we expect the stock to do well going forward. And we are positive with an ad rating and a target price of 550.
Thank you, Amit sir. Now with this, I'll take one last question for the day. So Shrikant sir, would you take this question along with your closing comments? So sir, Pranay is asking, should we invest in gold or silver ETFs?
Yeah. So for gold and silver, a lot of people are talking, discussing, and asking about whether to invest or not. But if we consider the overall performance of especially gold and silver in last 1 year, then it was completely exceptional. Still, we are seeing a lot of activity and buying interest in gold and silver. But if there is a view of at least next 2 to 3 years, then certainly one should look for adding gold and silver even at current levels and more on dips. But if there is a view of very short-term view, let's say of next 6 to 12 months, then we may see some sideways sort of activity because already we saw exceptional activity in last 12 months. It was over and above expectations. Also, it depends mostly upon the news flow from the global markets on the geopolitical tensions. For example, if there is any peace between between Russia and Ukraine, then in that case also we can expect some downward trend in both these commodities. But yes, if there is a long-term view, then the way there is awareness and the way the people have started investing in these commodities confidently in their SIPs as well as in their overall exposure in the market, I'm sure that this commodity is going to do well in the long run. So yes, one should look for adding them at current levels, more on dips, especially ETFs.
Thank you, sir. Sir, with this, we've reached the end of our webinar. Would you like to give closing comments also?
Yeah, sure. I think, see, like someone was asking about Nifty target by December end. So we can like talk about the Nifty's overall trend of last, let's say, 3 months. We saw consistent upward activity in the market. The market has crossed all its important level, including all-time highest level, which was around 26,275. Crossing that level gives a lot of confidence to investors, and as well as it starts helping to the broader trend of the market. Uh, Also, we need to see that how the breadth is panning out, how this leadership indicators, breadth indicators, they are performing. So till now, I'm not seeing any major change in the breadth indicators or leadership indicators. But the way there is activity in IT as well as banks, it is very clear that the breadth is going to improve in the near future, and in the near term, I'm going to say by the end of December, the market should be somewhere close to 26,500 or 26,700. Any dip will be an opportunity because downside looks quite limited. 25,800 certainly going to act as immediate support for the market. Below that, the chances of hitting 25,500 would turn bright. And we are talking about this downside is mainly because the rupee is not in control. It is weakening on day-to-day basis. So we need to keep a watch on the trend of rupee. And see, it is like very, very important to keep a track of currency's trend. It's not like in our hand to take specific call on the overall performance of the currency, because it completely depends upon the overall action from government, from RBI. And that's the reason we are not giving any specific view on the currency, but we are of the view that it should remain within the range of 87 and 91 for next few weeks or months. And now we are very close to the upper boundary of 91. So here, in case if there is any specific action from RBI or there is any news flow on the tariff side, we can see some appreciation sort of trend for currency. But for the time being, it is not in the near corner, and because of that, the market is finding difficulties to sustain at higher level. So here we need to be stock specific as well as level based. 25,800 should be the final stop loss for holding long positions. At higher levels, very high chances that gradually we may see the levels of 26,500. So tomorrow's credit policy will also decide a lot, on which I think Sumit has already discussed. And if the rupee starts falling, then I'm sure that the markets are like on the verge of crossing and sustaining above the mark of 26,300, which is an all-time high level for the market.
Thank you, sir, and thank you everyone for joining us. Your feedback means a lot to us, so please share your thoughts in the comment section below. And before we wrap, stay connected with us on Telegram, Instagram, and Twitter for regular updates. Once again, thank you.
Thank you.